Let me ask you a question. If your business has been losing money for years, but those losses have been reducing your taxes, how do you think the IRS would view that? Jason and Michelle Parker found out the hard way. They operated a real business. The expenses were real. The work was real. The effort was real. And they genuinely believed the business would eventually become profitable. For years, those losses helped reduce their tax bill. Then, the IRS audited them. When everything was over, the court disallowed hundreds of thousands of dollars of deductions. The shocking part? The IRS never claimed the business was fake. What the IRS questioned was something much more dangerous. Were they truly operating the activity with the goal of making a profit? Welcome to Ivy Smart Tax. Welcome to our Tax Trap series. This presentation is based on a real tax court case. Names, industries, and certain facts have been modified for educational purposes, but the tax principles come directly from a real case. And if your business has been reporting losses year after year, this story may be more relevant than you think.
Wait, so the business was real, the expenses were real, the work was real, and the deductions still got denied?
Exactly. And that's what makes this one of the most dangerous tax traps for business owners. Jason Parker owned part of a successful consulting company. His income was strong. Together, he and his wife earned several $100,000 a year. A few years earlier, they started another business that they believed would eventually become profitable. They invested significant time and money into it.
Honestly, that sounds pretty normal. A lot of business owners do exactly that.
Exactly. And that's why this case matters. Jason already had substantial income from another source. Meanwhile, the second business continued generating losses. Those losses helped offset other income on their tax returns. Year after year, everything appeared normal, until the IRS started asking a different question. Not whether the business was real, but whether it was truly being operated with the goal of making a profit. The first year produced a loss. That wasn't unusual. But then came another loss, and another, and another. Eventually, the business reported losses for more than a decade.
A lot of businesses lose money early on. Why did that become a problem?
Because the IRS wasn't focused on the losses alone. They were focused on what wasn't changing. They didn't see a clear path to profitability. They didn't see meaningful improvements. And they didn't see evidence that the business was moving toward making money.
So the issue wasn't the losses, it was the lack of progress?
Exactly. Because when losses continue year after year, the IRS eventually asks, what did you do to change the outcome? When the audit began, the IRS wasn't focused on how hard they worked or how much time and money they invested. Instead, they asked one simple question: where is the profit?
Ouch.
Because the IRS wants to see evidence that a business is moving toward profitability, not just effort, not just good intentions.
So they're not asking about the dream. They're asking about the results?
Exactly. Profit doesn't have to happen immediately, but the profit objective needs to be real and supported by evidence. Then came one of the most dangerous questions in the audit. The IRS asked, after years of losses, what changed?
In other words, what did you do to stop losing money?
Exactly. Because businesses that genuinely want to make money usually adapt. When results aren't improving, they make changes. They test new approaches. They try to solve the problem.
Because if profit is the goal, you'd expect some kind of response.
Exactly. And that's what the IRS wanted to see. Not perfection. Evidence. Evidence that management recognized a problem, took action, and actively tried to improve results. Because from the IRS perspective, a business doesn't just produce results. A business reacts to results. Eventually, the dispute reached tax court, and the court acknowledged something important. This was a real business. The expenses were real, the effort was real.
Then why did they still lose?
Because the court wasn't asking whether they worked hard. The court was asking whether the evidence showed a genuine profit objective.
So effort alone wasn't enough?
Exactly. The court looked at the overall pattern. the losses, the decisions, the adjustments, and the evidence supporting profitability. In the end, the court concluded the evidence wasn't strong enough to support the taxpayer's position. Eventually, the cost arrived. The court disallowed a substantial amount of deductions related to the activity. Years of expected tax savings disappeared. Tax liability increased, and interest started accumulating.
That's painful.
And here's the part that surprised me. The business didn't disappear. The work was real. The effort was real. But the tax benefits disappeared.
So they didn't lose the business. They lost the deductions.
Exactly. And that's what makes cases like this so expensive, because the cost often isn't just additional tax, it's interest, professional fees, and years of uncertainty. This case reveals something many business owners misunderstand. The IRS doesn't require your business to be profitable every year, but it does expect evidence that you're genuinely trying to make money.
So basically, show that you're actually running a business.
Exactly. A written business plan, profitability reviews, documented business decisions, pricing changes, cost controls, records showing what actions were taken when profits didn't appear.
So the goal isn't guaranteed profit. It's demonstrating a real effort to achieve profit.
Exactly. Because when the IRS asks questions, intent alone isn't enough. Your profit motive needs to be visible, documented, and provable. The hardest question in this case isn't how much money they lost. It's how long the problem had been building.
Because audit risk rarely appears overnight.
Exactly. The IRS looks for patterns. And once a pattern appears, decisions made years earlier suddenly become important.
So something that seemed minor years ago can become a major issue during an audit.
Exactly. That's often the biggest regret for business owners. Because the audit may happen today, but the facts being examined were often created years ago. The good news is, most tax traps can be identified long before an audit begins. The lesson from this case isn't to fear the IRS, it's to understand what the IRS is looking for.
So the goal is to fix problems before the audit?
Exactly. Better records, better documentation, better business decisions. Because the best audit defense usually happens before the audit ever starts. Now you've seen the trap, and once you see it, you have a chance to avoid it. Let me leave you with one final question. If the IRS audited your business tomorrow, what would you be most worried about them finding?
Because the biggest problems usually don't start when the audit begins.
Exactly. They often start years earlier, one decision at a time. And that's why this Tax Trap series exists, to help business owners identify risks before the IRS identifies them first. If you want to learn from real IRS audits, real tax court cases, and the tax mistakes that cost business owners thousands of dollars, follow Ivy Smart Tax.
Hopefully before the deductions disappear.
Exactly. This presentation is based on a real U.S. tax court case. Names, businesses, locations, timelines, and certain facts may have been modified, simplified, condensed, combined, or adapted for educational and presentation purposes. The tax principles discussed are based on the court's analysis and applicable tax law, but this presentation is not intended to reproduce the case verbatim. Every tax case depends on its own facts, records, documentation, and circumstances. A different set of facts could produce a different tax outcome. Nothing in this presentation should be interpreted as tax, legal, accounting, financial, or investment advice. This content is provided solely for educational and informational purposes. Before making any tax, legal, accounting, or business decision, consult with your CPA, tax advisor, attorney, or other qualified professional regarding your specific situation. Past court decisions do not guarantee future tax outcomes.